The 55% equity is an average, and it ranges anywhere from 40 to 60. But that's a full equity position for us because our clients are looking to stay rich and not get rich. So we're looking to manage their allocation so that they have growth while having protection on the downside. In terms of General Mills, which is our latest position, this stock's been very unloved by the market. So in the last year,
staples have been hammered.
Exactly. It's been underperforming by 35% in the last year. It's got a 6% free cash flow, $27 billion company. There could be consolidation in the industry. And I want to buy names now that have gotten beaten up. Okay, names that have already suffered versus names that have already moved in this kind of a market. But it also strikes to the discussion of interest rates. And it was just mentioned here, but there's a camp that thinks rates are going lower and a camp that thinks rates are going higher. And that's what's having an impact on sectors within the market.
Are you in the camp that they're going lower?
We think rates are going higher, absolutely.
What camp thinks rates are going lower? And what's the reasoning for it?
A lot.
I don't know, because I've
never heard anybody say rates are going lower.
There are a lot of people out there that are suggesting.
They may say the 10-year is going to trade around, but not real rates that drive the economy.
The ones that are talking about rates going lower are those that believe we're at peak earnings now, and the cycle is going to turn in 2019. Our view is that the cycle is going to accelerate this year and into 2019 as a result of tax reform, and rates are going higher. So we think fixed income, long-term bonds are one of the most overvalued asset classes right now, as well as interest-sensitive stocks. So that's why we don't own REITs, we don't own utilities, and we want to have names that will benefit from rising interest rates. That's why we're long banks and financials.
But the underpinnings, the fundamentals of REITs are actually, under a good economic scenario, are getting better. It's just, so that could be a buying opportunity if people sell them off because they're dividend proxies.
They've gotten hammered.
No, I know they have.
At some point, they would get attractive. But same thing with utilities. The REITs and utilities have gotten hammered. But I think our point is that in fixed income land right now, with the 10-year at 291, it's really suffering from what I characterize as these trade tape bombs, which constantly depress rates, depress the market, and at some point, rates are moving higher.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.